This great webinar. I would like to start my presentation by apologizing. We had some technological issue on the sound, but now the technical team have sorted out. So let's proceed. My name is Mustansir Ghulam Hussain. I'm a partner with PKF in Tanzania, a firm that is leading in providing audit, tax, and advisory services in Tanzania. This webinar is special in its own way because we have three key stakeholders participating together in this seminar. We have taxpayers, who are all of you, who contribute a lot to the government coffers. We have TRA, who are the enforcers of the law, and PKF consultants from PKF, who advises clients on paying the rightful amount of taxes. As we say, the taxes comes back as during the biblical times. They say, render Caesar what is Caesar's. So let's gain knowledge, let's understand the tax system and ensure that we are able to comply and pay the rightful amount of taxes. Without taking much of the time, I will go straight to introduce our panelists for this webinar. I will start first by introducing the panelists from PKF. On my left, there is Mustafa Mohammed.
Hi, everyone. I will be taking you through corporate tax updates, withholding tax, and tax administration updates.
Thank you, Mustafa. And then he will be followed by Eli Makando.
Hi, everyone. I'll be taking you through miscellaneous amendments and other key updates.
Thank you, Eli. And then after Eli will be followed by Zainab.
Hello, everyone. This is Zainab, and I'll be taking you through transfer pricing and landmark tax cases.
Thank you, Zainab. And Zainab will be followed by Hussein Kimeri from PKF.
Hi, everyone. I'll be taking you through the Finance Act update, of which we'll be looking at the Finance Act update 2020, Income Tax Act updates, Tax Administration updates, and VAT updates.
Thank you, Hussein. Now let us introduce our fellow friends. I will start from my right.
Good afternoon, everyone. I'm Diana. I'll be participating and sharing with you experience and also to answer some questions for clarification. Thank you.
Just to let you know, Diana is one of the most experienced person in this team. She has more than 25 years of experience in taxation. Let me ask a friend from my left to introduce himself.
Hello, everyone. My name is Ezekiel Swimmer, and I'm from Tanzania Revenue Authority under the Research, Policy and Planning Department. I'll be here also contributing to my experience in order to move forward with this taxation system into the country. Thanks.
Thank you. I will also ask now my friend Malia to introduce himself.
Hi, everyone. My name is Martinus Milimalia. I'm based at TRA headquarters. Meanwhile, I'm at Tax Consultation Bureau along Samora Revenue. We are together to respond where possible on some tax matter issues. Thank you.
Thank you, Mr. Malia. Let me ask our two friends from TRA to introduce themselves.
Yeah, good afternoon, everybody. My name is Adam Kobelo. I'm working at DRD head office, CDR's office. I'm a principal tax management officer at the technical service unit. Thank you.
Hi, everyone. My name is Joseph Moya. I'm from TRA, Large Taxpayers Department. I'll be taking you through this session by providing clarification on different matters. Thank you.
Oh, thank you very much from the TRA team. So we have a great team who is now ready to discuss various tax matters. Without taking much of the time, I'll request our first presenter to start with the slides and the presentation. Mustafa, over to you.
Thank you so much, Mustansir, for the warm welcome. While we were waiting over here, I just noted that today I'm the only presenter who's not wearing glasses. So that must mean that something's really wrong with my eyes. But without further ado, and without just directly diving onto the slides, what want to as well highlight is, for a matter of fact, technology has made our life easier over the couple of months that has passed by. I remember we had similar seminars in the past, whereby people used to fly in from all over East Africa to attend, even out of Tanzania, within Tanzania as well to attend. This made this sort of seminar is special on its own, and we're able to allow participants with a click of a button to just straight away log in and share their experience. So what today is, and for those who've already attended our seminars in the past, we always love questions. Please don't forget to put in your comments, your questions, and we will have dedicated time to answer as many as questions as we possibly can. Moving on, I'm going to be taking you through income tax updates across from 2016 all the way to 2019. What's the reason why we're doing so is just in case you've missed out on certain tax updates across the years, then we find it necessary that you as a taxpayer, have you taken a chance to look into those incentives or not? I'd like to start with income tax. While the slides are coming on. When the slides are coming on, I'll slightly start with, whenever we talk about income tax, to our mind, what happens is we think about paying tax based on your wealth, based on the gain that you've earned, based on employment income that has been earned. So, is that always the case? We ask ourselves. Not really. There is a tax called turnover tax that we pay, and we've noted that over the couple of years, there have been changes to the turnover tax regime, and I'm trying to take you through what are the key changes that have happened across from 2016 all the way to 2019 and a bit towards 2020. So looking through, we've noted that across the 3-year period or across 4-year period, if you're having consecutive tax losses for your business, and this normally applies to entities and not individuals, you have to pay a turnover tax based on the tax losses that you've accumulated. So it's not always paying tax based on your gains, but paying tax as well when you're on your when you are having some consecutive tax losses. The tax rate that is based on turnover tax has changed over the couple of years. It's always been there for the past 5-6 years for those who possibly have not come across it. The tax rate has changed from 0.3% all the way to 0.5% in 2018 updates. There was a decrease actually in the time frame for people to pay turnover tax. Previously, what used to happen is a taxpayer who has 5 years tax losses were falling under the turnover tax regime. But now what has happened is that it's as well shifted to 3 years. There was a bit of lack of clarification as to if I'm having tax losses for 5 years, on which year do I pay the turnover tax? It used to read for 5 years, you pay tax on the 3rd year. As we go on, there are some illustrations. We will be sharing these slides with you. Hello? Hello? So as we move on through the slides, we will take you, there are some illustrations. We will be sharing the illustrations with you. We will be definitely sharing the slides. So you can have a look at a practical experience as to how does the turnover tax work in Tanzania. My colleague over here as well, when he's talking about the Finance Act updates, he'll explain to you specifically what are the tax loss rules that have kicked in 2020, because there are some restrictions that have to be factored in your return of income that will be followed. As we head on, we'll as well looked at some changes towards certain sectors of the business as governments, every year they sit down together, they pass finance acts, they look into the possibility of trying to thrive certain sectors. And we are trying to look through boosting the sectors for various, especially pharmaceutical. We're talking about, we're looking at motor vehicle assembly lines. We're looking at as well leather industries. And as well in 2019, we noted some changes that related to the sanitary pad related manufacturers as well, who were able to get some sort of a tax break. Some were receiving 20% tax breaks, some were paying 10% taxes on their corporate taxes. What would be interesting to note would be the data behind it and how many actually taxpayers have benefited through those new incentives and brought in investment in those certain sectors, as we do thrive as Tanzania to look into making an industrialization agenda as we follow the agenda. We as well noted certain small business tax amendments. I have a very close friend as well, and other friends as well within the office as well, who've really appreciated one of the new changes that had happened somewhere in 2019, whereby presumptive taxpayers had actually, the band rates had increased. So this allows more people to fall into the presumptive tax regime. And mind you, presumptive tax regime applies to individuals, small scale businesses who are trying to make it big, but they need a bit of profit. They are making the profits during the year, and over course of time, they will be able to make it into the big tax brackets. But so what is the incentive that really came in 2019 was presumptive tax rates were for those taxpayers who had turnovers of less than 20 million across the year. And now the thresholds have actually increased from 20 million to 100 million shillings during the year. We'll be sharing those in the slides as well. What are the tax rates? There's as well been a decrease in tax rates. What this has allowed small scale businesses to actually not be paying as much as taxes as normal corporations, to allow them with a relaxed relief. This increases the tax brackets as well for taxpayers to come in. We've as well noted some changes towards the charitable business or charitable taxation on entities who have been having some sort of, over the couple of years, we've noted that they've been having a lot of matters to address, these NGOs. And as time has come in, we've noted that the two key things that NGOs need to comply with, and one of the key thing is, do they meet the test of an entity with a public character? So there was always a debate between NGOs and the sector itself as to what constitutes an entity with public character. So these definitions were inserted somewhere in 2017. This brought in a lot of clarity. We did have practice notes. We did have regulations that guided NGOs, but this sort of brought in much, much more clarification. We as well tell all our taxpayers, whoever's donating, even NGOs, we re-emphasize that you need to make sure that you have a charitable status certificate, because just merely registering an NGO does not mean that you're exempt from any taxes. Or if you're making a contribution to an NGO, that doesn't mean it's automatically tax deductible. So that's why we need to make sure that NGOs meet the test of entity of a public character, and as well that they have a charitable status ruling. I think now the slides that are on, I'll jump straight through the next slide. We're talking about restricting withholding tax expenses. We've spoken, my colleague over here, Zainab, will actually be explaining to and taking us through what is going to be the implication if you have net of tax contracts, because this is a big thing. We've noted many taxpayers, even our clients, sometimes what happens is, just a mere example, a practical example would be, a landlord might tell you, the rent is 1 million shillings, that's it. The withholding tax, please pay it at your own expense. Now, what happens to that is that you end up paying tax on behalf of the landlord and you end up expensing that. So there are a lot of cases which says to avoid net of tax contracts. And this has as well been implemented now in the tax laws in 2017 to reaffirm taxpayers and to make sure that this there's a clarity on this sort of an expense. How does it get treated? We as well looked into the non-commercial vehicle capital allowance restrictions. These were increased from 15 million shillings to 30 million shillings. So previously there was a restriction in how much tax deduction was allowed or not allowed in terms of motor vehicles for non-commercial. So this increased, this allows more depreciation for your business. We as well noted that the NBAA guidelines as well in 2017 issued required whoever's presenting financial statements to have a certificate or a certification from a registered CPA. So this as well, the tax laws brought in line with that requirement to make sure that they as well as TRA as well, or whoever's submitting a tax return, the financial statements should have that certification for from a certified accountant. So all financial statements have to have it. Another big tip is we've noted as well, many times when filing tax returns, there's certain key documents that have to be filed. Apart from audited financial statements, you need to even attach your withholding tax certificates. And my colleague as well, Zainab, will take us through when to attach transfer pricing documents with your tax returns as well, because the penalties are punitive. And we find it very important to make sure that your tax returns are submitted accurately. Trying to move to the next slide. We looked into non-resident taxation. An update is that previously foreign aircrafts had to pay 5% single installment tax when transporting horticultural products, which is now exempt. So there are two actually items: horticultural products and fish products are now, if a foreign aircraft is carrying that from out of Tanzania, then these are now exempted. The 5% single installment tax has been removed. What this means is that this eases up the process of transporting these products, which horticulture and fish products are very perishable. So this reduces the time lag. This as well helps reduce the cost for transporting and eventually as well allowing taxpayers to have their products to be marketed at an affordable costs. We as well noted that there are changes in the individual non-resident individual tax rates, whereby what has happened is that the tax rate has reduced from, actually increased, sorry, from 20% to 30%. So now what happens is that non-residents of Tanzania, individuals, the total income is subject to tax at 30% rate, which is similar to a resident taxpayer individual. And therefore, this means that the tax rate has shifted from 20 to 30%. We even look into the employment taxes, which my colleague Hussein will take us through. Employment taxes over the course of 12 years has actually reduced. We've tried to analyze each of the year across the 12-year sector as to what would be the implication, what is the take home, what is the pay. So just briefly looking at the chart, if you look at a person, the first line, July 2008, a person who's earning employment income of 1.5 million, he takes home 1.1 million shillings. We come down to date, which Hussein, my colleague, will take us through. The tax rate has actually reduced significantly. So the same person earning same amount of employment income, he is subject to 1.2 million shillings. So that's a big up, and that's definitely a really nice welcome. Definitely, that means that whoever's going to get any salary this month, they will probably be getting at least another 50,000 as compared to previous years. So this is a really good initiative. We as well noted that the tax band rates had increased. So that was a very warm welcome. We as well noted some key changes over the years on withholding taxes. We noticed that previously in 2013, 2016, there were some definitions on professional services, which I know many of us who's listening to this seminar will be having definite questions. Which services provided by a resident are subject to tax and which are not? We are ready and we're welcoming those questions. But definitely what has happened in 2016 was there was an inclusion of the definition in the Income Tax Act for the professional services. And that was a welcomed definition to define what is subject to withholding tax and what is not subject to withholding tax for resident services. However, there is a note that it is a very wide definition, and we find almost all services are immediately falling into that definition. But definitely as we go through and your comments come through, we can even discuss with our colleagues over here with TRA as to how do they as well look into it. Because there's one look from us as tax consultants, there's one look from yourselves as taxpayers, and there's as well one look from TRA who are the enforcers. So we look forward to a lot of questions on that. We as well noted that construction works, the clarity was brought in 2016, are subject to withholding taxes. And they clarified as to how to charge the withholding tax because you have a material element and you have a service element. We as well noted that withholding taxes by non-resident service providers, there was a lot of conundrum on this matter as to what sort of services provided by a non-resident service provider is subject to withholding tax. We've got some landmark tax cases that we'll be taking you through. So I'll allow Zainab to take you through those details. We as well noted a lot of exemptions that were abolished across the 2-3 years, which we'll take you through. Let's look into the Tax Administration Act. Definitely the Tax Administration Act was a welcomed act that came in 2015. This sort of streamlined the administration process, allowed a taxpayer a one-stop shop to look into how does the tax get administered, who is the collectors, and as well, what are the objection procedures. And there was a lot of detail. There have been regulations that have been published, and we will be taking you through some of the key changes that were brought in. Let's look into installment taxes. We've noted several taxpayers at times end up in this sort of a underestimation scheme whereby the taxes that they pay are less than 80% of the taxes that are due, especially for corporations. So if you have installment taxes that are due during a year, you need to make sure that you pay at least 80% of your tax. But in that, what change actually has come in, because this change has, the 80% test has always been there, that you need to pay 80% of your corporate tax through installment taxes. What was the key change is how was the formula of calculating the interest or the penalization that was arising when a person falls into paying less taxes. So there was some interesting calculations on that that came in 2017, which clarified on that. We noted a welcome change as well, that no new TIN holders, new TIN registrars, what has happened is that they've been given a moratorium, or I'd say a 3-month gap. So what happens is they pay installment taxes delayed. And that was as well a welcome move to allow new TIN registrars to start the business, give them a little bit of room and start paying taxes. So that one as well was a big thumbs up, similar to the presumptive tax regime and the employment tax changes that have come in. Another matter is statutory interest rates have been decreasing. These are not actually a change in the Tax Administration Act that we've noted over the year, but we find it important that you understand what is happening in terms of interest rates. It's been declining. So what this means is when you're issued with a tax assessment, or if you have delayed in tax payments, what are the interest rates that you'd be charged? Somewhere in July 2015, interest rate was 16%. And today, as we speak, the interest rate has gone down to 5%. So that means that the penalization and interest rate has declined over the years. We've got an illustration over here for how to calculate the underestimation. So we will be sharing these slides again, and you could have a look and go through the same. If you have any questions, again, we're welcome to the same. Another hot topic, which I know we've all been discussing, even last night I got a call on the same, is remission of interest and penalty. Many taxpayers are looking forward and were looking forward to this. We noted somewhere that there was a tax amnesty that was introduced, which is a big up. Many of our clients actually did apply for tax amnesty, and it was a really successful tax amnesty. Almost all our clients were able to get the tax amnesties approved. So that was a big up. We've as well noted that there are new regulations that have been published to reduce the interest and penalty burden on taxpayers, which my colleague Ellie will be taking you through in detail. So I won't go too much into detail over there. So there was a big up, the TRA, and when these new amnesties were introduced, there was an expectation of collecting and bringing voluntary taxpayers into the bracket. And this allowed, they estimated to have a tax collection of 500 billion. And so that was a really thumbs up. And many clients did benefit, and many taxpayers did benefit from this scheme. So it was definitely a big thumbs up. Objection and tax appeals, although the processes are more or less the same, we noted whenever you're issued an tax assessment, you need to pay 1/3 as a tax deposit if you're objecting that tax assessment. So that has always been there. However, a taxpayer, there was a bit of a slight gap, but it was a much more a mutual understanding which we had through the tax administration. But now at least the law is in place that if you want to object and you have to pay the 1/3, by when should it be paid? And it's very clear that now you have to pay it by the due date of filing your objections. So failure to do that as well, the implications have been brought up in the Tax Administration Act updates. We as well noted there were amendments in 2017 that clarified that if you park your objections and go through appeals, you go to the tribunal and court of appeal, any delay in that, the delay in that process does not mean that your interest and penalty is ceased. Your interest does accumulate. And therefore, if you lose a case 5 or 6 years down the line, what that means is you still have to pay the same interest and penalties. Again, EFD, a daily topic that is there. We are requesting everyone, and everyone has been hearing that you need to comply with your EFD, issue tax receipts, demand tax receipts, fiscal receipts as well. So what we noted is that the penalty rates have changed from 3 million shillings to 4.5 million shillings. So that has been increased. We as well have a few articles on the same as well to allow taxpayers to understand EFD machines, to help them reconcile any variances that they've noted. So we will be sharing these slides, and the links will be there to access how do you really reconcile any variances that you note between your EFD, your VAT, your financials, and TANSIS if you're an exporter especially. So we do have an article there which detail discusses EFD. Well noted a few other changes that were in place. One is disclosure requirements for subcontractors. There has been a punitive penalty that has been implemented if you do not do those disclosures. We noted as well the informal sector, the machinga cards that we call, have as well been implemented over since 2017. And this allows the informal sector to register with the TRA. And this is as well a big up throughout these years. We as well noted that in the Finance Act 2019, there was the tax ombudsman office, which was discussed, and which as well helps to administer, and taxpayers could go to, and possibly we'll discuss with the TRA and if there are some questions on the registration of this office, whether it is active, and what are the plans perhaps as to when would this be active. We as well noted that there are some refund of tax laws that have been amended, which is now clearly stipulated that all types of taxes you need to request your refund for within 3 years. If you don't do that, then your refund becomes time barred. So make sure, taxpayers, if you have constant tax credits, you follow the VAT refund, or not only VAT refund, but any other tax laws refunds are opted for within 3 years. We have a practical illustration over here that if a person for 2013 is looking for a refund today of 5 million shillings, he's not able to get that refund because he is time barred. Today is 2020. When we look at 2017, a person can still go for a refund or an offset for future taxes. This is the last slide that I'm going to speak about. We're talking about risk on jeopardy assessments, which we've noted commonly as well has increased because these assessments are issued by the tax authorities if they find that there are certain non-compliances that a taxpayer has not complied with taxes, or they are about to become bankrupt. So the tax man has the power to issue a jeopardy assessment. So what my prayer to everyone is, when you get a paper from the TRA requesting for information, requesting for clarification, please don't ignore it. Make sure you respond to them on time to avoid the risk of being issued jeopardy assessments. And this marks more or less the end of my slide. Thank you very much. And I know that you might be having a lot of questions. Please park them in the comment section, and we will have a special Q&A for those who've just joined in to answer as many questions as we can. Thank you very much.
Thank you, Mustafa, for your excellent presentation. I think anyone who is joining now, we are assuring that you have not missed anything, because we will also share the link of this presentation so you can go through it. But the main essence of today's webinar is that we will want as many people as possible to ask very many questions to see how some of the areas of tax concerns can be addressed. And I clearly like your presentation, where government has reduced corporate tax on pharmaceutical industries and motor vehicle assembly industry. So that's a strong drive for industrialization, plus raising informal tax rates to 100 million. That helps to allow smaller business to grow to a larger business. It reduces the cost of compliance. Without taking much of the time, let me ask our friend Eli to take us through what he has to say.
Thank you, Mr. Nasir, for the opportunity. Thank you, Mustafa, for keeping the ball rolling. Well, I'm going to take you through a few updates, but actually are crucial to the daily business of your operation. And we're going to start with the VAT Act. Most of you at home and at the office actually pretty much have not come across this act, because it's basically a portion being administered by the Income Tax Act, but actually it's the Vocational Education Training Act. It puts a portion on the issue on SDL, whereby it's a cost to the employer, but actually from the past years, it came from 6% to 5% to 4.5% to now, whereby my colleague was going to take through the Finance Act 2020, which came up to 4%. And 6 was actually around 2001, 5% was actually around 2013, 4% was actually around 2016, and currently is at 4%, which is actually in 2020. But also to keep note that I know the margin is actually very small, because it's just an amount on 0.5. I know some of you as accountants, actually your Excel could have rounded it off to 5% because it's just small. But actually, on a nutshell, it's a number that could actually impact the costs of the employer on his daily expenses. So if you say about SDL exemptions, recently we had a lot of exemption in the past, including charitable organization, as my colleague Mustafa had pointed it out, UN agencies and the rest. But actually in 2016, they added up one, which was very crucial, which was for the registered education institution from the primary group to the tertiary group, whereby they're also exempted from SDL. It has a logic, yes, because these institutions actually teach people to have those skills. So it's a bit of relief to them as well. But also we'll keep on looking on the same hope that in the coming years, they'll be reduced. But remember, whenever taxes has a cut, there's always a smile at one end and also a laughter at an end. So people this year had a smile that actually does 0.5 deduction. And people also had like a question like, where is the 0.5 being compensated? But actually in this Finance Act, that 0.5 was not compensated anywhere, which is big. Thank you for the government on looking into that and looking at the employer cost as well to be reduced in a marginal way. If you look, something else is on the VAT Act. We had some removal and exemptions. Actually, these were actually previously exempt on exemption. Now they're actually taxed. We can have few examples to mention that as the financial services, which are subject to VAT unless they're provided for free. And a good example, which is a quick one, is on the ATM cost that we usually have. Previously, when you go to the ATM, people were not looking at anything, perhaps the charges or anything on that zone. So you just go there, you bring your numbers, you have your cash coming out, you're happy, you move on. Nowadays, people are actually cautious, even on number of times they go to the ATM, because actually it's a bit of an 18% extra cost that has been there. A person at first will see that, oh, 18%, is there bubblegum coming out or something? But actually, no, to be cautious that some of these costs which are actually provided for free in the last period are actually VATable, except for those which are provided for free. If you look on tourism, to give a glimpse, in 2016, it was actually taxed at 18%. Well, it sparked a lot of questions to the government that, will tourists come into the country? Will this actually succeed? Yes, but it was a blow to most of the people that actually the numbers was okay, and it came out very positive. Yes, it might be a matter of people already expecting to come to Tanzania to have that thought, but also it's a matter of looking on the other challenge on the competitive and comparative advantage out of it, which is just a question that the government has to look. Because you see, as Tanzania, we might have a comparative advantage. We have more national parks around and the rest. But also we have, in the future, we have to look on the competitive side of it, if actually this could flourish in the long run. Also, we had a quick one on the insurance services, whereby some services are actually now VATable. Example, life insurance. A person will like say, oh, life insurance is VATable. Is my life also adding value to anything? But yes, it's a way that we try to keep things in order, and so that at least to widen up the tax base of the country. If we look on zero-rated supply, we also had one update, which was on the zero-rated supply to Zanzibar, whereby a local manufacturer of goods in Tanzania who exports to Zanzibar is actually zero-rated, which was a good step for the market in Tanzania, because we have this union matter. But also we only looked on the relief on logistics services, whereby they introduced ancillary services which are crucial to the logistic transportation to be zero-rated, which is actually a cut to the cost on this, because you remember VAT is on consumption base. So anything that includes like the storage and the rest, actually it's zero-rated for the meantime. Let's look on the pure concept of VAT, which is on consumption basis. We had export of service, and in 2016 they actually added up something on relating to export of service and they added a definition on what actually service should be zero-rated and what service should not be zero-rated. So if you look on the chart on the PowerPoint, definitely it will show you that if a customer is outside Tanzania at the time of supply and you give him that service should be zero-rated. So it's a key point to understand on the consumption rule of the game, but also it's a key point to keep yourself that when you're providing a service, and if you're not under that categorization on issues, then you might be VATing that service or you might be zero-rating the service. If we move on to something relating to payment and filing of VAT, yes, to those accountants who usually don't sleep on the 20th and the 30th day, remember now in 2016, they introduced that it comes to the 20th and not on 30th. At least the government felt that you should go home early a bit. But In that case, the VAT filing came on to the 20th and not the 30th. That is something that everyone knows in the meantime. Well, it's a good thing because it reduced the backload on the end of the month. But also they made a clarification on the VAT filing when it comes to a public holiday or a Saturday and Sunday. And they say that you have to file it on the first working day following the Saturday, the Sunday, or the public holiday. A question might come on the Q&A, what about the payments? That will come to that point of time. Something that no one likes to have it on his expense and provisions or anything is the bad debt. I know everyone loves making money and you're here for cause of that. TRA also wants this country to be developed. So it's also collection is part and parcel of everything that we do here. Well, timing for bad debt has been a bit clarified. Previously it was 18 months. Previously it was 12 months. Now it's 18 from the Finance Act 2017. But remember, there are rules to this. The debt has to be followed and you have to have the proof that this debt is followed. You have already accounted the same debt on the VAT return. You have collected the money in cash. So it's not that you only write off a debt by doing an increasing or decreasing adjustment. No, you have to keep in cautious that there are rules that you have to look into so that you can have this adjustment on your VAT return. Yes, something good that the country is, I'm sure that most of this country is actually based on agriculture as the background of the country. Yes, now industrialization is there. There's a complement to the same. So in 2017, actually July came a miscellaneous amendment that kept, you cannot claim input tax on raw agricultural products for exporters, but we thank the government that in 2019, before the implementation of this, they actually overruled it and say, no, exporters of raw agriculture products should be able to claim it. Because it's good that they can claim it because of the fact that it's more expensive if they cannot claim the same. And to the external market, it will be a point that is credit exportation for raw agriculture products. So now, since 2019, it's actually, you can claim the same. Well, a point to complement my colleague Mustafa was on the issue on the valid invoice for tax refund. Well, there are things that any person who files a tax refund should be careful on. And the Finance Act 2019 came up very clear into things that you should consider. One, there should be a date of the issue. There should be a name, TIN, and variant of supplier. There should be a description. There should be a total consideration, and the value of what you actually claim should be more than 100,000. Well, I'm pretty much sure if one or twice we have come to your office and singing the same song, it's a song, but it's what actually will help you not to be discredited when TRA actually verify your VAT filings. And please consider that whenever you're doing this, ask for a receipt whenever buying, issue a receipt whenever you're selling. Let's look on miscellaneous amendment and other key updates. We have one which was really interesting, which was the VAT Regulation 2018. Well, it brought about something on VAT on financial services and introduced that whenever you're doing business with the bank, you should be issued with that VAT statement or periodic statement. This is usually issued by the bank on the 10th following day of the month. I know people have already kept this on practice, and I'm sure that without this, you cannot actually claim anything that is vetted by the bank. Well, we will share your practice on the discussion as we continue. And in 2018, also the VAT Regulation General Amendment came up with an apportionment of input tax for partial traders. This was a really crucial thing because most of the traders had the loss on claiming most of the partial traders had the loss on claiming their input tax. So they came up with a way that they complement Section 70 of the VAT Act, but also give the ability for a person who is actually a partial trader to be able to claim what is correct. And if you do remember, we have two steps category here. We have the first step, which actually is just average method, and you have to distinguish your input tax on 3 categories, whereby it's category A, which is the ones that you actually can relate to taxable supply, category B, which are the input tax that relates to exempt supply, and category C, which are the input tax that relates to both supplies. So under this, after you categorize your input tax on those 3 categories, you go to the second step, whereby it's the direct method you're attributing the same. If anything falls on category A, which are the input tax that attributes to taxable supply, that means you can claim the full amount. if anything falls at a category B, which is the taxable input tax relating to exempt supply, you cannot claim the same. But if anything fall under category C, which is the input tax that attributes to both taxable and exempt supply, that means you can use section 70 of an apportionment formula. And I've kept just a reminder on this other slide on what I was just speaking about. But remember that if anything is greater than 90, you claim the full. If anything is less than 10, you cannot claim. But the good thing is VAT Act also can be complemented by Income Tax Act, which my colleague also had a point on the beginning. And what you cannot claim, actually, you can expense it and it becomes allowable. Well, this is just a flow chart whereby you could see where your purchases are and the way that you move. But remember, these slides will also be shared to you, and pretty much you can test as a roadmap. Keep it as if it's just a directional track on how you have an input tax and how you can apportion it and complement it with the VAT regulation for 2018 relating to the two method of average and direct method. Something that also was very interesting was on the electronic tax stamps, where our colleagues from TRA also will, I'm sure some will have a question on that, which it goes back to 1998, whereby the first paper stamps were there. In 2018, they tried to keep it more electronic, in the sense that to lose the loopholes that were there on the whole procedure of electronic tax stamp. So now things are not anymore paper, and the government is actually going paperless. Actually, it's good for the environment. Big up to those who are actually environmental conscious. But this was also introduced to capture the pure production records on time. And we can also have the same briefed on the Q&A section. Something also which was also there was Umbrella, which they came up with the online system. Now, if you'll be interested that things are actually moving from paperwork to online systems. So everyone is trying to move from the normal traditional way of filing things to actually going digitalized. So please, if you haven't taken any computer course, you should take it right now, because it will be a problem. Well, there's an issue on VAT verification. Well, I remember when this came out, I was like, whoa, my picture is actually different. Yes, we are allowed to take new photos, do fingerprints and the rest. And it was very interesting. If any one of you who haven't done the same, TRA is open for you. The team is here, the officers are here, they can clarify on the same. If anything if any one of you haven't done the same. Yes, as we said, things are going online right now. We have withholding tax e-filing system. We have a full article on this, on the challenges and complexity of the same, but it came from 1st of July, 2018. So please do not say that I've paid you money and I don't have a certificate, or I'll issue the certificate in the next 30 days. Sorry, that's not the case. Everything is online, so make sure that you acquaint yourself with the online system. It's not difficult, it's not complicated. Yes, looking on the tax administration regulation, we had an issue on a regulation 2020, which by it complemented on the loophole that came in Finance Act 2018, whereby the the minister had to give the regulation or order. Now, this is a regulation to complement section 70 on interest remission of interest and interest and penalties, whereby we'll have a Q&A section at the end, but actually that's the slide which covers the same. You should be very careful that decision that the commissioner makes here cannot be appealed. So this time, a hand that takes money from you is actually a hand that also gives you something. So do not get afraid to reach out and apply, because it's an opportunity to all of you to enjoy this remission. Yes, it came on the issue on pension fund. I'm sure every one of us here, without the experience, will one day go to Bahamas, have a beach and relax. Yes, but we have pensioner list, and I thank Mustansir that he's actually contributing mine every month. Thank you for that. But yes, for private companies, actually, you go back to NSSF. For government staff, you have the PSSSF, which is over there, which started from 2018. But a big question will be, what about treatment of casuals? For those private companies, what about gross versus basic salary? It's a question that we also have to keep in light. Well, wrapping on the same, I think it's be interesting that you have seen the changes that happened, and please be interested on questions as well so that we can have a Q&A session at the end. Thank you very much.
Thank you, Eli. Interesting. One of the things that I come to learn is there is VAT Act, isn't it? There's no SDL Act. Yeah, there's no SDL Act, yeah. So there's VAT Act. And you forgot to mention that even PKF has gone online now. Our training is online, so there will not be any tea breaks, lunch breaks. It will be straight through and through.
No washroom breaks.
No washroom breaks for participants. So we are also online, and this is a new concept of running the training through webinar. We can interact as fast as possible. Yes, interesting. Let me hand it over to Zainab, who will tell us whether we are related or not.
Okay, thank you, Mustansir. So I will now be taking you all through a very new topic, which is transfer pricing. So basically what we will talk about is what is transfer pricing. Transfer pricing is the price that related parties charge to each other, okay? Now you would ask me, what are related parties? So related parties are entities who either have similar shareholding, they may have a parent subsidiary relationship, they could either be having common management, or they could either be brothers or sisters. Yeah, brothers or sisters. So basically, they are entities whereby one entity would have a significant control over the other entity. Let me give you an example of a related party, all right? Let's say, or before we go into that example, let me first explain to you the base of transfer pricing. So the base of transfer pricing is that all related party transactions should be at arm's length, yeah? Like arm's length. Now, let me give you an example. My friend here, Mustafa, yeah? So today is Friday, and tomorrow he's invited to a party. So he goes to the barber shop for his haircut, yeah? And luckily the barber shop is of his brother. So he goes over there, everything is done. And when he wants to leave, the brother says, I cannot charge you, but you're my bro, yeah? Now, at the very same moment, there is another customer who just came in and got the same thing done as Mustafa. And when that customer is about to leave, what happens is, here is your bill, pay me my 30,000 shillings, yeah? So now that is a totally big no in transfer pricing. So for example, even if Mustafa was the brother of that barber, he still had to charge him 30,000. Now, we look at 30,000 is a very small amount, but for multinationals, they would be having millions and millions of transactions on a daily basis. So that 30,000 times the million of transactions could lead up to a big, big amount. Now, transfer pricing all over the world is governed by the OECD. Okay, OECD is the mother body of transfer pricing, and it has issued several guidelines and reports on how transfer pricing should go about. Now, we look at how transfer pricing came into Tanzania. So what had happened was that in 2011, there was a case decided at the High Court of Kenya where the taxpayer won the case. The main reason behind it was that there were no transfer pricing regulations at that time, local transfer pricing regulations at that time in Kenya, because of which the court had to give its decision based on the OECD guidelines. So after that, Tanzania introduced its transfer pricing guidelines in 2014, transfer pricing regulations in 2014, which were under the income tax regulations, and followed by a transfer pricing guideline. Now, the aim of the guideline was to elaborate or give guidance on how your TP policy should be. Then from 2014 to 2018, the income tax transfer pricing guidelines were followed. And then in the year 2018, new guidelines were introduced under the Tax Administration Act, the Tax Administration Transfer Pricing Regulations 2018, which revoked the old regulations, yeah? And then in the year 2020, like recently, the new guidelines based on the transfer pricing regulations were introduced. So what are the new guidelines on? So they were just issued on 1st July 2020, and the guidelines give a good explanation and an elaboration on the application of the tax administration guidelines. So it basically tells you from A to Z on what should be there in your transfer pricing policy. Because a transfer pricing policy, it's not just a 10 to 12 page document. It is almost a document which would have around 50 to 60 pages. Yeah. So mostly it elaborates on, as I told you, how a TP policy should be documented, the arm's length principle, the transfer pricing methods, intra-group services and financing, commodity transactions, corresponding adjustments, and APAs. So you would be wondering, AP what? Okay, APA are advanced pricing arrangements. Yeah. Yeah. So basically, advanced pricing arrangements are an arrangement that a taxpayer has with the TRA before even entering into a controlled transaction. So basically, what will happen is that the TRA and the taxpayer would meet, they would talk it out, and then they would agree on a price, that this price would be the chargeable price for this transaction. So that APA is valid for 5 years. And the good thing in these guidelines are that they are more elaborative than the previous ones, and they are really, really good. I mean, heads off, they are really good. Yeah. So basically, if you want to know that how your document should be, then we will share with you the link for the guidelines as well, and you all can go through it and read through it, and it will give you a guide on what exactly should be there in your TP policy. So as I spoke that there was a change in regulation in the 2018. So we give you a brief highlight on what exactly were the changes. So one of the change was the consistency with the arm's length principle. So for example, whenever a tax audit comes for transfer pricing, there could be a case where there is a transfer pricing adjustment done by the Revenue Authority. Now, as per the old regulations, the penalty was 100% of the tax unpaid. But with the new regulations, the penalty is 100% of the adjustment. Giving you an example, let's say my taxable income for the year 2020 is 200,000 as per my books. Now, after the audit, the taxable income was adjusted to 1 million. Right? As per the old regulations, my penalty would have been 30% of that 800,000, which is the difference, which was the tax payable, and as well as my tax would have been 240,000. But with the new regulations, my tax payable, my tax liability is 240,000, but my penalty is the 800,000, which has been adjusted. Yeah. I feel that the main aim by introducing this is to make taxpayers comply with the transfer pricing regulations to avoid profit shifting from Tanzania to other countries where the tax rates are low. Another change was the documentation itself. So the main change was that if you have related party transactions within a year, which are more than 10 billion with your resident or non-resident entities, then you have to mandatorily submit a transfer pricing policy with your final returns and the financial statements. The new guidelines provide that you could ask for an extension for submission of TP policy, but it is in line with the Tax Admin Act that the maximum you could get is 1 month. Another change was that whenever you're doing a function analysis, now you see a function analysis is the main body of the transfer pricing. With the function analysis, it will clearly show what entity A and entity B do in the transaction for them to be compensated that way. So with the new regulations, it is now required that both parties should clearly provide detailed functions on what entity A does and what entity B does. Another change was the change in penalty. So in case if you are unable to submit a transfer pricing policy with your final return when your transactions exceed 10 billion or within 30 days upon request by the commissioner, the penalty as per the new regulations is 52.5 million. One more change was that the new regulations recognized the OECD, which I explained is the mother body of the transfer pricing all around the globe. Another issue was on the commodity. The main issue was on commodity transactions. So like a commodity transaction is basically a transaction whereby you are exporting items which are there on the stock market, on the spot market, coffee, tea, cotton, gold. Now, whenever, and in Tanzania, a lot of companies are doing commodity transactions, are into commodity transactions. So now when you are dealing with commodity transactions, the method that you should apply is the CUP, which is the comparable uncontrolled price method. You cannot go into any other method. And how you arrive at the CUP is that you need to compare your prices to the spot market rate, a spot market price, sorry. So the price at the spot market price for that day would be your transfer price for the commodity sold to your related party. The new regulations also provided that a person with control, meaning related party transactions, should have a contemporaneous transfer pricing documentation. And we have highlighted these 9 points that should be there in your transfer pricing document. Now, let us look at the common red flags that are raised with regards to a transfer pricing document. Now, you see, from our experience, a transfer pricing should always be forward-looking, meaning that you first need to see if whatever you're transacting is at arm's length and then transact. What is currently happening here is that people already transact and then they come to make a TP document. That should not be the case. A TP document should be in place and then you transact according to the TP document. Another issue is that people not having a transfer pricing policy at all. One more issue would be is when application of a wrong method. So you really need to be careful on what sort of a method you are applying to benchmark your transactions. With regards to this, we have done an article on transfer pricing, which we will share with you with the other materials that we share, and you can go through it and understand what methods are the correct methods or the most appropriate methods for benchmarking any transaction. Another point is that whenever you have a transfer pricing policy, please do ensure that all related party transactions are covered in that policy. And as well, please ensure that even when you are signing off your financial statements, there is a disclosure requirement that related party transactions should be disclosed in the financial statements. So please ensure that whatever is disclosed in the financial statements is hand in hand or in line with what is there in the transfer pricing document. We ourselves, we have had many experiences that entities do have related party transactions, but they are not disclosed correctly in the financial statements. One more issue is that you see the main basis of transfer pricing is the substance over form. So let's say you would be having an intercompany agreement whereby company A is doing functions A, B, C, D, E and is compensated 60% as per the agreement. And company B is performing functions X, Y, Z. So he is compensated 40%, assuming A is compensated 60%. Now, when you look at what is actually happening on site, company B is performing more functions than company A, but it is compensated less. So although you submit intercompany agreements which show this is doing this is doing this, but what will determine the arm's length price is actually what is happening on site. So the more functions you perform towards a transaction is the more you should be compensated to the transaction. So yeah, now we move on to landmark case laws. But before that, if you have any more questions on transfer pricing, please do post it on our question box and we will respond it to you during the Q&A. Now, as we go on with landmark case laws, so yeah, Mustansir, you saw, yeah, brothers and sisters also should transact it, should arm's length, yeah?
I will have issues with my wife, let me know.
Yeah. So landmark case laws. So these landmark case laws, we have highlighted a few cases which have been decided over the past few years and have set a good precedence to other tax matters. we start up with a case which was on gross and net of contract arrangements. So basically what had happened was that an entity had entered into net contracts with its employees, okay? And what it was doing was that it was deducting payee, it was paying payee on behalf of its employees by grossing up the net contracts. So during a TRA audit, TRA identified that the company was doing such, and this allowed the payee expenses that the company was expensing out from its books. Now, the taxpayer was aggrieved by the decision because he found that there is no wrong in grossing up the amounts as far as he paid the net amount to its employees. This case went to the tribunal, to the board, to the tribunal, as well as to the Court of Appeal. And then finally, on 6th March 2020, which is this year, the Court of Appeal ruled in favor of TRA and said that TRA was correct to disallow. The main reason being is that the use of gross up method is a kind of transaction which does not have a legal backing in Tanzania. And it would as well contradict the whole essence of withholding, that the employer is the withholding agent who should withhold from an employee's salary and not for the employee. Yeah. So this shows that a big no to net contracts. Sincere, I hope we don't have any net contracts. Huh? Yes. No, eh? Yeah. Yeah. Okay. So now we talk about another case, which is discussion on the purchase of software. Now, many a times we purchase many softwares like antivirus or possibly a software on maybe Windows or so. And we think that it's a purchase for us, that we purchase that software and it is our software, but technically it's not, because it is not owned by you. You're just getting a right to use that asset. And with that, there was a case whereby the Court of Appeal ruled in favor, again in favor of TRA, that that payments for software or purchase of software is actually a royalty, and 15% withholding tax should be deducted on the same, be it a resident or a non-resident payment. When will a software be treated as a purchase is that if it meets the condition that the ownership of that software is passed on to the purchaser. But if it is not the case, then you should start paying your withholding tax on the licenses that you are purchasing. Yeah. One more case is on the reverse VAT on imported services. So basically, this was a case that had happened based on the old VAT Act. Yeah. And what had happened was that an entity was getting imported services from a non-resident person. Imported services meaning he was receiving services from outside. And the law required that whenever you're having an imported services, you are supposed to account for reverse VAT, meaning that you're supposed to account it on the output as well as on the input part. Now, when an audit happened, when the tax audit happened, it was found out that the taxpayer was not doing so, and VAT was charged on the said service. So the taxpayer argued that the effect of it is nil. So why should I be penalized for the same? But it was not in line with the law, and therefore the taxpayer was required to pay the VAT. This case as well went to the Court of Appeal, and the Court of Appeal ruled in favor of TRA. But when looking at the current VAT Act, which was introduced in 2014, with the current VAT Act, it clearly defines what imported services are. So as I explained earlier, imported services are services that are not made in the URT, in the United Republic of Tanzania, meaning that they are given from outside. Secondly, you need to see that if that service, if I would have got that service from Tanzania, would that service be VATable? Like, for example, if I'm getting consultancy services from a resident person, of course it's VATable. So if I'm receiving it from outside, then also it qualifies as an imported services and should be accounted for reverse VAT. The third condition is that whereby an entity is having both exempt and taxable supplies, it is then required to account for reverse VAT. So for an entity who is having full taxable supplies, meaning he is supplying or selling items which are either wettable at 18% or at 0%, zero rated, then he is not required to account for reverse VAT. But if he has a mix of exempt and zero rated, then he is supposed to account for reverse VAT. Another case was on the source rules payment. Now, this case was interesting. What had happened was that in 2016, the Court of Appeal had decided on a case of Pan-African Energy, whereby it had held that withholding tax on foreign payments is not deductible, and therefore, there is no withholding tax on foreign payments. But in 2018, there was another case of Tulo Tanzania versus the Commissioner General, whereby it was held that the decision of the Pan-African Energy was wrongly decided, and services rendered and services rendered, or the word rendered, is totally different to supplied and delivered. So basically, from this case, it was held that when you are paying for a non-resident service, withholding tax at the rate of 15% is applicable. Yeah. So this marks the end of my presentation. I hope you all learned something from it and enjoyed it as much as I did presenting it. And I would like to now roll the ball to Mustansir.
Thank you, Zainab. I think so. This transfer pricing is very interesting for me. Reason being, my wife does some work for PKF and I never pay her for last 5 years.
You should have paid.
Yeah, so then transfer pricing makes me to also pay her because she is related party. It's arm's length.
You definitely should.
Okay, and then secondly, when I read that the regulations that TRA has come out with, so there is no template in transfer pricing, because I usually get calls from taxpayers that, do you have any template that can help? So it means now there is no template. Every transfer pricing document is separate and unique to the business that person is operating.
Yes, it is.
Yeah. So then I will want all the taxpayers who are on this call to take note of that very many people are using templates, but every transfer pricing should be uniquely developed to your business and the circumstances to your business. It's very specific. Maybe I now hand over to our friend Hussein Kimeri, who will keep us up to date with what changes are coming through.
Thank you, Mr. Nasir. Let me take you through the Finance Act 2020. As my fellow presenters over there, we are presenting the tax updates for the past 4 years. Now we are in 2020. So let's concentrate on the changes in the 2020 Finance Act. I shall be starting with Income Tax Act changes, whereby we have a couple of updates, especially on tax on a representative business. As we are aware that most of the time the government, we are just trying to see how can tax these income earners who are non-resident who are earning the income in Tanzania through representative. So at least now in this Finance Act year 2020, the government has come up to the module that at least the income earned by these non-residents are now charged in Tanzania, and it's through its representative business. So this is just a thumb up to the government, and it seems like it tries to widening up the tax base. So another change is a limitation by a minister to exempt income tax on strategic project whose income tax payable does not exceed 1 billion shillings. And this has been done purposefully just to fasten up the development projects which are financed by the government. Another change is on deductibility of expenses, especially all expenses which are incurred by the taxpayers in respect to donations made to AIDS, trust fund, and to the government in fight against the COVID-19. So these expenses will now be treated as deductible expenses. So another issues which is hot is restriction to utilize unrelieved tax losses, as was addressed by my previous speaker, Mustafa, about this. it is specifically about AMT. For those who are making laws for 4 years consecutively, in the 5th year now, if this taxpayer is becoming in a payable position, so to what extent now this taxpayer can offset the losses against this income payable, which has been derived in this current year 2020, for instance. So the law says the taxpayer can only utilize 70% of income of the current year against the income of the current year. So previously, it was like this, taxpayer was allowed to deduct the entire amount of accumulated losses against the income tax payable on the current year. Again, we have clarification, I can say a bit of clarification on the source rule of withholding tax payable. So over here it says where the service is consumed is all what it matters. That means before people were just confusing what is considered to be as a source withholding tax payment source in your RT. Others were just saying, no, it's a place of payment. Others are saying, no, it's a service, it's a place of rendering of the service. But at least this Finance Act 2020 has clarified that where the service is consumed is where the withholding tax will now be payable. Another update was concerning the withholding tax on commissions. Now withholding tax at the rate of 10% has been introduced on the commissions earned by the agent of banks and digital payments. For instance, this M-Pesa, Tigo Pesa. So whenever the principal pays the commissions to the agents, now the principal will now be liable to deduct 10% of withholding tax. Now the question now remains, if this withholding tax, which is deducted by principal, will now be treated as final or non-final? We can just chip in the discussion in the next slides. Then we have, this is a very famous update. I hope everyone has already heard about this, which is the reduction in employment tax rates. For instance, a person who is falling under the highest tax rate, highest tax band, at least now can save 50,000 shillings per month. It can be seen like this 50,000 is just a nut, but trust me, for the government, this is a lot. This is a lot. So a thumb up to the government for providing these incentives to all employees in Tanzania. Then we have another update, which is removal of tax exemption to the special economic zone investors who are supplying 100% of their products here in Tanzania. So previously, this type of investors were exempted from income tax, but now taxable. But this can be seen from this angle that the government is trying to standardize or to encourage the internal market competition among the traders who are trading within Tanzania. Another hot issue is a smile to parliamentarians, member of the parliament. Previously, I think in Finance Act 2016, the exemption was removed on the benefits which were provided to the members of parliament. But now the government has restored it again. So there is no any tax which will be paid on the benefit derived by the parliamentarians after the retirement. So, and this shall be deemed to have come into operation from 1st July 2016. So now I think the members of parliament are happy because their benefits now are no longer taxable. So now let us come to look at the VAT updates. Of course, we have major two updates over here. The first one is VAT claims by exporters of raw materials, of minerals and agricultural products. So the input tax or the costs incurred on purchases of this material for the purpose of exporting outside Tanzania. So the income tax incurred is now liable or to be claimed in the VAT returns. This is just to encourage the agricultural business in Tanzania as well as exportation process. Also, we have VAT exemption on insurance of agricultural products. So the agricultural products, especially the cost incurred to acquire that insurance cover to those who are dealing with agricultural products should now not bear VAT. And this is done purposefully to mitigate the risk from unforeseen tragedies such as droughts, floods, and even this uncontrollable pest. For instance, currently we have seen in Kenya, they were hardly attacked by this pesticide, we call it nzige. So Tanzania has just taken the measure forward. So the payment of these insurance covers, which are relating to the agricultural products, are now exempt from VAT. So these were the only changes which were just hot one for the VAT changes. Now let us look at the changes under Administration Act, Tax Administration Act. Now, finally, the Act has recognized the formal representative of taxpayer, who should either be a practicing advocate, a tax consultant, or any other person who is authorized by a power of attorney by the taxpayer. So for now, the taxpayer can be representative by either of these people. Also, we have changes under notice to obtain information. This is mainly under section 44 of Tax Administration Act, and this is purposefully for the period whereby the TRA or commissioner asks a taxpayer for verification or audit or investigation purpose. Now, if a person is served with a notice of information, so that the taxpayer can furnish all the required information to the commissioner, now is given only 14 days to make sure that all the requested information are saved or submitted to commissioner. But now, from the practical experience, most of the taxpayer now are being audited maybe for the 3 or 4 past years. So the process of compiling documents and other relevant information within 14 days, it could not be enough. But then the law is flexible. It's allowed for the application for the extension of time. So a person, if you feel like you are not able to collect those required information within 14 days, now the Act allows you to seek for extension of time. But then what is the consequence for not submitting information on time? Assume this taxpayer has not even applied for extension, nor has not submitted even a single document, and this 14 days has lapsed. As we know, that commissioner has a power to issue the jeopardy assessment. And one of the effects is that taxpayer shall be barred from using such information or documentation as evidence at the stage of objection or appeal. So over here, we see the importance of responding quick on the letters from TRA, specifically this notice to obtain information. You're just given 14 days to respond. If you are feeling like you are not able to furnish those required information that are within 14 days, you are allowed to seek for extension, but not keep quiet, because you'll be ending up with receiving this jeopardy assessment. And the bad thing is you won't be allowed now to use such information or document at the stage of objection or appeal. Now let's come to changes under objections to tax decisions. Now, objection of tax decision shall be accompanied by relevant documents or information which the taxpayer intend to rely upon to support this objection at the time of lodging the objection. We used to apply, or we used to lodge this notice of objection in some instances without attaching the supporting documents, fearing that the process of collecting information will take longer. At the end of the day, this taxpayer could lose the right to object. So normally we used to furnish, or we used to submit those notes of objection first, then the attachment are following up. But now for this changes, that habit now is no longer applicable, because as soon as you lodge your objection, and all of your supporting documents should be attached together at the time of lodging the objection. Another interesting change or part is 100% deposit of the tax liability. If a person is aggrieved by any decision by the commissioner and decide to make an objection, in normal circumstances, a person is required to pay 1/3 of the tax which is not in dispute. So by this time, you need to pay or to deposit 100% of tax liability. but this only applies to the people whose commissioner think that these people or this objector intends to permanently leave the country. So at least this makes sense, because if a person is objecting and he could pay 1/3 and the person is intent to leave the country, so the government like, hey, just bring the money first, 100%. Then if you are on the way to outside of the country, it's okay, because we have already have your 100% tax liability, which was assessed. So these were the changes and objection, as well as we have objection termination, that provision of information and documentation on time. So over here in the process of determining the objection, the commissioner may require additional information necessary to determine for determination of the objection. So suppose you have already lodged your objection and all of your supporting documents you have submitted to TRA, but then again, the commissioner, in order to certify himself, he is allowed to ask for additional document. Now, what is the time limit that a person should submit this required information? It's 30 days. Within the 30 days, this person should be able to submit this required information. But then the law is not fixed, it's flexible as well. Over here, if a person feels like 30 days is not capable of submitting all the documents, may seek for extension from the commissioner. So, but now suppose a person has given or have been served a notice with commissioner to tender the additional documents, and the 30 days has lapsed, and the person is still sit on the notice without doing anything. So what is the consequence? As we know, as usual, that the commissioner may issue the assessment based on what information, whatever information he have. But again, if the person is not, is not into agreement with the commissioner's decision, cannot use such other documents or additional documents to be used as the evidence in the stage of appeal. So again, over here, we are just reminded to respond on time. Whenever the notice we are receiving from the commissioner, we need to respond on it on time. As well as we have a time frame to determine the objection. Over here, the commissioner has given 6 good months to be able to determine the objection. Now the question is, what if the 6 months are lapsing without objections being able to be determined? So the law is clear that the commissioner shall confirm the assessment. The commissioner shall confirm the assessment. So what does it imply? It means that if you're objecting, or if you are able to lodge the objection to the commissioner, now you should make sure that within the 6 months, you should be able to get these objections being determined. So unless otherwise, the assessment will be confirmed by the commissioner. Now, what about other various tax changes in Zanzibar? Of course, we have so many changes in Zanzibar, but I would like to address only 2 interesting changes. The first one is relating to the previous point on the time frame for determination of objection. Now in Zanzibar, the case is different. For them, the commissioner in Zanzibar is given only 3 months to determine the objection. If not, the commissioner will now be forced to amend the assessment based on the objection. Now we see here the case is different. In Tanzania mainland, if the commissioner is not able, or if the commissioner cannot determine the objection within 6 months, now the objections should be, the assessment could be confirmed. But for the Zanzibar, the case is different. If the commissioner fails to determine the objection within the good 3 months, now the commissioner is forced to amend the assessment based on the objections. So the case is different as well in the matter of following up. Here in Tanzania mainland, if you're lodging your objection, so it means day and night you should be following up to make sure that 6 months your objection gets determined. But for the case of Zanzibar, if you're lodging your return and the time is elapsing, you're just going to chill, knowing that at the end of the day, if 3 months are elapsing, the assessment are going to be changed or amended based on the objection submitted. So another interesting thing is about VAT rate in Zanzibar has been changed, decreased to 15% now. So in East Africa, Zanzibar becomes the lowest region to have with VAT at 15%. Still in Tanzania mainland, we have the same rate, 18%, but in Zanzibar now is 15%. Now this makes the end of my presentation, but before handling the mic to our moderator over here, I would like to ask a question to audience over there, of which in subsequent time, we could have a time to discuss all together. As we know that currently Tanzania has shifted to middle income earner or middle income country status, but then the only question to ask you as a taxpayer, what are you expecting from the government for the country to be categorized as income earner? Or did the tax matters be the same? Or do we expect any audits? Or do we expect more audits, more investigation, more examination? That answer will be just a sort of homework for the weekend, but you should think about that. Thank you.
Thank you, Hussein. Excellent. I was not aware about Zanzibar VAT rate. Eli, you shift your retirement from Bahamas to Zanzibar, 15%. So it's just nearby. Take a boat, Azam boat, and within 1 hour you are there.
That's very right.
And secondly, Hussein, it's nice to become a parliamentarian, but
Yeah, sure.
it's an election season, so maybe after this presentation we can rethink.
To Tanzania.
To Tanzania. Okay. Thank you very much to all our great presenters. We have tried, tax is a very wide subject. It's very difficult to discuss all the tax changes even in 1.5 hours. But the main essence of this webinar was